They gave it their all. They waited for the cloak of night to descend. They hiked the margin thresholds. They overwhelmed the order book with fabricated short positions. They painted the tape a crimson hue as the weekend approached. For 2 days, their objective was to convince you that the silver rally had faltered, that the anticipated collapse had finally materialized. Yet as dawn broke over London this morning, the dust settled, revealing the bull still standing firm. We have just borne witness to one of the most significant market indicators of the past 10 years. It wasn't delivered via a press release, nor was it a pronouncement from the Federal Reserve. It was the raw price action itself. The market didn't merely rebound, it surged. The substantial upward gap, which erased the previous session's losses in a single trading period, deviates sharply from typical market behavior. It's a declaration, a powerful testament to a bear trap snapping shut on the very institutions that orchestrated it. It signifies the realization by short sellers that there's no physical metal left to back their speculative ventures, and it confirms a fundamental shift in the buy-the-dip strategy, now embraced not only by individual investors but also by national treasuries and industrial powerhouses. If you succumbed to panic and liquidated your holdings during the downturn, I have some unfortunate news. You provided the liquidity they needed, the very fuel for this ascent. However, if you maintained your position, understanding the intricacies of the game, you're now witnessing your vindication unfold in real time. In this in-depth market analysis, we will forego predictions and instead examine the scene of the alleged crime. We will meticulously dissect how the major financial players attempted to obliterate the price and why, for the first time in 4 decades, their arsenal proved ineffective. We will elucidate the mechanics behind the V-shaped recovery and the specific signals indicating that the market's low point has been established. The fabricated price attempted to deceive you, but the physical market has spoken the undeniable truth. This is the detailed account of a failed market crash. To grasp the intensity of this resurgence, one must first comprehend the trap that preceded it. In the realm of financial markets, progress is rarely linear. Bull markets are designed to be challenging, intended to inflict maximum discomfort upon the greatest number of participants. What we recently observed, a precipitous and sudden decline that instilled widespread apprehension, was a textbook bear trap. Let us examine its operational mechanism. The financial institutions are privy to the locations of stop-loss orders. They are aware that countless retail investors have established automatic sell orders just below critical psychological price points, such as $60 or $62. To secure liquidity, these institutions must trigger these orders. Consequently, they employ a catalyst, such as an increase in margin requirements or an alarming news headline, to nudge the price downward just enough to activate these triggers. Suddenly, the stop-loss orders execute, and the retail investors automatically sell. A dramatic red candle appears on the price chart, reinforcing the bear's conviction that the established trend has been disrupted. They then enter the market en masse, initiating short positions, wagering that silver will revert to $50. However, the trap then springs shut. The institutions are not selling to exit their positions, they are selling to acquire. They drive the price lower to generate selling volume, which they then absorb entirely. They purchase contracts from the panicked retail investors and from the overconfident bears. Once their portfolios are filled, they withdraw, ceasing the artificial downward price pressure. Natural demand then reasserts itself with the force of a compressed spring. The price skyrockets, gapping up overnight, leaving those who sold at the bottom with unwanted cash, while those who shorted are now facing substantial losses, necessitating a panicked buying spree to cover their positions, further fueling the rally. This is precisely what has transpired. The decline was a facade. The recovery is genuine. The ferocity of the upward movement unequivocally demonstrates the underlying market's strength. Weak markets exhibit a sluggish rebound, akin to a deflated ball, whereas strong markets demonstrate a vigorous bounce comparable to a tennis ball. Silver has rebounded with the exuberance of a Super Bowl. We previously discussed the margin nuke, wherein exchanges increase capital requirements to compel selling. Historically, this has been the ultimate weapon. In 2011, it proved highly effective. Margin increases led to a 30% collapse in silver prices within days, deterring speculators for a decade. They attempted it again, this time by escalating the cost of doing business, aiming to make it prohibitively expensive to maintain positions. Initially, it appeared successful, with a dip in price. However, something unprecedented occurred. The market absorbed the shock. The reason for this resilience lies in a fundamental transformation of the market's composition. In 2011, the market was dominated by investors with limited conviction, speculators utilizing 20 times leverage who were unable to meet margin calls. When these calls arrived, they were forced to divest. Today, the market is characterized by strong hands, industrial consumers, family offices, and sovereign wealth funds. These entities are not engaging in speculative gambles. They are hedging supply chains and safeguarding wealth, possessing substantial financial reserves. When the exchange demanded increased capital, these buyers did not liquidate. They transferred the funds. This represents a catastrophic development for market manipulators, signifying a miscalculation of their pain tolerance threshold. They anticipated that a 50% margin increase would cripple the bull market, but instead, it merely agitated it. When a market disregards adverse news or regulatory pressures, it signals profound underlying strength, indicating that buyers are not price sensitive, but rather volume dependent, prioritizing the acquisition of the commodity over margin requirements. The failure of the margin nuke to precipitate a sustained crash serves as a definitive signal for the next upward trajectory. The major banks have expended their ultimate gambit, and now they find themselves disarmed, confronting an unyielding force. Let us consider the psychological implications for the market. Markets are propelled by two primary drivers: greed and fear. However, a third, more potent engine exists: regret. The V-shaped recovery, characterized by a rapid price decline followed by an immediate rebound to new highs, is a potent regret-generating mechanism. Consider the individual who sold on Friday, driven by apprehension and the sight of red figures, believing they were acting shrewdly by planning to repurchase at a lower price, perhaps $55. They retired for the night with a sense of security, only to awaken on Monday to find that silver had surpassed their selling price. Rather than saving money, they forfeited their position. They are now confronted with a choice: acknowledge their error and repurchase at a higher valuation, or await another market downturn. Most individuals opt for the latter, refusing to buy back at an increased price, and instead watch as the price ascends to $65, $68, and $70. Their regret transforms into FOMO, fear of missing out, ultimately compelling them to panic buy at the market's peak. This is how market bubbles are formed. The shakeout effectively expels early, less committed participants, thereby lightening the load for a more rapid ascent. It also forces hesitant investors to chase the rising price. The recent volatility has served as a cathartic event, purging excess leverage, resetting sentiment, and transforming overbought conditions into neutral territory without fundamentally disrupting the established trend. From a technical perspective, it was a masterclass in market architecture. Regardless of whether it was intentionally orchestrated by financial institutions or a result of natural market fluctuations, the outcome remains consistent. The path of least resistance is now upward. But who was responsible for acquiring assets during the dip? It was not the retail investor who was deterred by fear. The volume data tells a different narrative. The buying activity commenced in Asia but gained significant momentum in London. This constitutes a critical element of the situation. For years, London has been the primary source of supply, serving as the ultimate seller. However, this morning marked a reversal. London shifted its allegiance. In the subsequent segment, we will delve into this pivotal shift in London's market behavior. We will investigate why the bullion banks in the United Kingdom, traditionally instrumental in suppressing prices, are now engaged in frantic purchases of physical metal. We will explore the prevailing rumor that the available supply has reached its nadir and explain why this alteration in institutional conduct guarantees the surpassing of previous price peaks. The bear trap was merely the preliminary phase. The London pivot is the catalyst. Do not depart. We must address the issue of available supply. For those just joining us, let us recap the unfolding events. Friday witnessed a market decimation, followed by a significant price gap upward on Sunday night. However, the truly defining narrative, which will shape the trajectory of this bull market for the next 6 months, transpired merely a few hours ago in London. For 40 years, London has been synonymous with the suppression of precious metal prices. The London Bullion Market Association serves as the nexus for major bank trading and price determination. Historically, when prices escalated excessively, London would flood the market with supply, acting as the ultimate seller. Whenever New York engaged in panic buying, London would calmly liquidate its holdings, moderating the market. But today, London did not sell. London became a frantic buyer. Upon the opening of the United Kingdom market, we observed substantial, aggressive bid orders flooding the tape. This represents a profound change in market dynamics, akin to a firefighter dousing a blaze with gasoline instead of water. Why this alteration in strategy? Why are the bullion banks now actively driving prices higher instead of suppressing them? It is not due to a newfound affinity for silver. Banks operate not on ideology, but on obligations. Their shift in posture is attributable to a critical, seldom seen metric: the available supply. We frequently discuss inventory, but inventory and available supply are distinct concepts. Inventory refers to the metal held in vaults, while available supply represents the metal that is actively for sale. In the next segment, we will expose the depletion of silver's available supply. I will explain the leasing mechanism employed by the banks to suppress prices and the reasons for its recent malfunction. Furthermore, I will demonstrate why the erstwhile ultimate seller has now become the primary buyer. The bear trap ensnared retail short sellers, but the available supply trap has now ensnared the banks themselves. Let us address a common misunderstanding. Bearish analysts often cite LBMA vault data, proclaiming, "Observe the 800 million ounces in London's vaults. There is no shortage." While their numerical reference is accurate, their interpretation is fundamentally flawed. These 800 million ounces represent an iceberg. The overwhelming majority, likely 85 to 90%, is already committed. This metal is held by ETFs, sovereign wealth funds, and family offices that vaulted it years ago and have since relinquished control. This metal is not available for sale. It is strategic inventory gathering dust. It will not be traded at $30, nor will it be traded at $60. The only metal that influences price is the available supply, the unallocated metal residing in dealer inventories, available for leasing to refineries, sale to entities like Apple, or delivery to consumers. Historically, this available supply was substantial, amounting to hundreds of millions of ounces. However, over the past 3 years, as India has absorbed significant quantities, not from ETF holdings but from the available supply, the dealer pot has been depleted. Consequently, while the iceberg of total silver remains visible in London, its tip, the available supply, has vanished. This has precipitated a liquidity crisis. If a corporation like Samsung requires 1 million ounces today, they cannot acquire it from ETF holdings. They must access the available supply. But the available supply is now exhausted. Therefore, the price must escalate sufficiently to incentivize holders of diamond hands to liquidate. This threshold is unlikely to be $60. It may not even be $100. We are in a situation where the genuinely available supply is virtually non-existent, despite the appearance of healthy total reserves on spreadsheets. This explains London's panicked response today. The banks, seeking to depress prices, found the dealer pot empty. To comprehend the bank's current purchasing behavior, one must understand the leasing market, the shadowy core of silver transactions. Bullion banks do not merely hoard silver, they lease it. They extend loans of silver to industrial entities, such as refineries and electronics manufacturers. The borrower receives the silver, utilizes it, and commits to returning it at a later date, along with interest. This system enables industrial operations without requiring outright metal purchases, while simultaneously allowing banks to profit from their holdings. Crucially, it generates a perception of virtual supply, as the same ounce of silver can be leased, returned, and leased again, creating an illusion of market liquidity. However, a critical issue arises. What if the industrial user consumes the silver, transforming it into a component for a solar panel or a missile? In such a scenario, they cannot return the original metal. They are compelled to procure a new bar from the open market to fulfill their obligation to the bank. For years, this was a straightforward process, as silver was relatively inexpensive, but now refineries are experiencing operational halts and the available supply has dwindled. Industrial users are contacting banks, stating their inability to return leased metal due to scarcity. This situation leads to a surge in silver lease rates, signaling a market-wide shortage and indicating the bank's desperate efforts to reclaim their physical metal. Today, we are witnessing evidence that the leasing mechanism has malfunctioned. The banks realized that the silver they leased out is irretrievably gone, perhaps integrated into products in Germany or California. This creates a deficit on their balance sheets. They possess silver assets recorded on their books, but their vaults are empty. To rectify this, they must enter the spot market and purchase physical bars to replace the consumed quantities. This is the essence of the London pivot. The banks are not speculating on price appreciation. They are urgently attempting to fill the void in their vaults before regulatory scrutiny intensifies. They are effectively covering short positions on a physical level. This buying activity is price insensitive. The exact price, whether $63 or $65, is secondary to the necessity of acquiring the metal to balance their accounts. This constitutes an exceptionally potent form of buying pressure. A final layer contributes to the panic in London: the unallocated account. Many affluent investors and institutions hold silver in unallocated accounts in London. This means they do not possess title to specific bars, but rather a claim on a pool of silver held by the bank, analogous to depositing cash. You don't own specific banknotes, but rather a claim on the bank's liquidity. For decades, banks operated a fractional reserve system for silver, potentially holding 100 ounces of physical silver for every 500 ounces of claims issued. They operated under the assumption that not all clients would demand physical redemption simultaneously. However, recent news concerning Samsung and the volatility experienced on Friday have instilled apprehension among major investors. Family offices are beginning to express skepticism regarding unallocated accounts, opting instead to convert their holdings to allocated status, demanding possession of specific bars with identified serial numbers, preferably stored in private vaults. This constitutes a bank run on silver. When a client transitions from an unallocated to an allocated account, the bank must withdraw 1,000 ounces from the general pool and assign it to that client. This silver is then removed from the available supply. If the bank was operating on a fractional basis, holding only 20% in actual metal and 30% of clients demand physical allocation, the bank becomes insolvent. It must then hastily enter the market to procure the missing bars. This is precisely the factor that has propelled this morning's rally. It is a silent bank run, not characterized by individuals queuing at coin shops, but by billionaires issuing legal demands to bullion banks for the physical segregation of their assets. The banks are now compelled to buy during dips to satisfy these demands. Their attempt to crash the price on Friday proved futile. The demand for allocation actually intensified over the weekend. Consequently, the banks are now mandated buyers. Thus, we have the bear trap, the London pivot, and the leasing crisis. The stage is set. We are currently trading around $63.35. Directly overhead lies the psychological barrier of $65. A breach of this level will open up the chart with virtually no resistance until the all-time highs are reached. In the next segment, I will present the technical roadmap for the week, explaining why $65 is the critical threshold for short sellers, and I will detail precisely what to anticipate upon the opening of the United States market in a few hours. Will American investors join the buying frenzy, or will the Federal Reserve attempt one final intervention? The available supply is depleted, the banks are ensnared, and the squeeze is imminent. Let us examine the charts in segment 3. For those who have followed this analysis, the fundamental factors are clear. The bear trap has failed, London's available supply is exhausted, and physical buyers are now in control. However, we must now turn our attention to the technical indicators, as even in a supply-constrained environment, price movements are not strictly linear. They are characterized by a series of contests. Currently, the entire silver market is fixated on a single figure, $65. We are trading in the vicinity of $63.35. We have successfully recovered the losses from Friday, but $65 represents a distinct level. It is not merely a resistance point, it is the critical zone for short sellers. In segment 3, I will elucidate why the major banks will defend this level with extreme intensity this week. I will explain the mechanism of a gamma squeeze, a latent force within the options market that could trigger a vertical price surge if this barrier is breached. Furthermore, I will provide a precise forecast of what to expect as the United States market opens shortly. The initial phase of rebounding has been accomplished. The challenging task now is to break through. Here is the projected trajectory for the next 24 hours. Why is $65 so pivotal? Is it an arbitrary figure? No, it represents a liability. Within the derivatives market, speculators purchase call options, which are essentially bets on an upward price movement. Currently, there is a significant concentration of open interest at the $65 strike price for both the December and January contracts, indicating millions of ounces betting on a price breach above $65. This presents a critical challenge for the banks that sold these options. If silver remains below $65, these options will expire worthless, allowing the banks to retain the premium. However, if silver surpasses $65, the banks will be obligated to deliver millions of ounces at a disadvantageous price. This triggers a phenomenon known as delta hedging. As the price approaches $65, market makers become increasingly apprehensive. Their automated trading systems compel them to purchase silver futures to hedge their exposure. For instance, if they sold a call option covering 5,000 ounces, they may be required to buy 2,000 ounces of futures as a protective measure. The crux of the matter is that their buying activity further drives up the price, intensifying their apprehension. Consequently, they are compelled to acquire even more futures, leading to a further price escalation. This self-reinforcing feedback loop is termed a gamma squeeze, analogous to the phenomena observed with GameStop and Tesla, and it is poised to impact silver. If we breach $65 with substantial volume, market makers will transition from a neutral stance to mandated buyers. They will be compelled to chase the price upward to $66, $67, or $68, merely to cover their existing exposure. This is the vacuum effect we have discussed. Above $65, the air is thin and resistance dissipates because those who were defending the level become active buyers. This explains the anticipated significant price volatility around $64.80 or $64.90. The major banks will deploy every available resource to prevent this critical juncture from being breached. They will engage in paper selling and trigger stop-loss orders. However, if the physical demand from London and Asia persists, this dam will inevitably break. We are approaching the opening of the United States market, a critical juncture. Typically, the US market open is where rallies falter. Historically, the pattern has been consistent. Asia buys, London buys, and then New York opens and systematically suppresses the price, almost like clockwork, with a 10 a.m. decline. However, today feels distinct. The reason is that American investors are becoming aware of the same information that prompted London's panic. They are reading about the Samsung battery, observing rumors of Chinese exports, and crucially, witnessing the positive price action on their screens. Americans are drawn to momentum. When they observe silver increasing by $1.60 overnight, they do not perceive it as overly expensive. They perceive it as an opportunity they might be missing. FOMO is a powerful motivator. It is probable that we will witness a wave of retail investment flowing into ETFs at the market opening. This influx of capital necessitates that the ETFs purchase physical metal to meet the demand, thereby adding another layer of buying pressure on top of London's bids. However, there is an opposing force, the dollar index. The Federal Reserve and the US Treasury closely monitor the silver price, A runaway silver price is indicative of uncontrolled inflation, which diminishes the perceived strength of the dollar. Frequently, during the U.S. trading session, there is a notable appreciation in the dollar index intended to cool down commodity markets. The upcoming contest at the U.S. Open is set to be a showdown between the FOMO, fear of missing out, enthusiasts and the dollar's staunch defenders. Should the price remain stable throughout the morning trading period without a significant downturn, then those who bet against it will find themselves in a precarious position. This would signify a failure of the dollar's defense and an indication that American investors are joining the worldwide rush. Pay close attention to the trading volume. A rising price accompanied by substantial volume suggests a genuine upward trend. Conversely, if the price climbs on meager volume, exercise caution, as it could be a deceptive maneuver. However, considering the bear trap scenario that unfolded on Friday, the odds appear to favor the bulls. There is an additional indicator we should monitor today: the mining stocks. Last Friday, when silver prices plummeted, mining shares were severely impacted. Companies like First Majestic, Pan American, and Hika saw their stock values decline by 4 or 5%, as if the world were collapsing. Yet today, silver has recovered. Based on simple calculations, the mining stocks ought to experience a substantial surge at the opening bell. If silver is trading at $63.50, these companies will be exceptionally profitable. Nevertheless, mining companies often trail behind the price of the physical metal during market shifts. Wall Street operates with a degree of inertia. They await confirmation, needing assurance that the silver rally is not a fleeting illusion. This situation presents a temporary arbitrage opportunity for the discerning investor. If silver maintains its gains, the mining stocks are compelled to follow suit. It's a matter of basic arithmetic. The tension between the metal's price and the stock prices has reached a breaking point. As the American market commences trading, focus on the Junior Silver Miners ETF. If silver appreciates by 3%, the ETF should ideally jump by 6 or 7%. If it only rises by 2%, that represents an advantageous situation, indicating that the stocks are undervalued relative to the commodity they extract. This disparity arises from the apprehension of equity traders who recall Friday's events, while commodity traders acknowledge the reality of the supply deficit. Eventually, equity traders will likely engage in a panic buying spree of mining stocks, and this catch-up movement could prove to be exceptionally strong. Thus, we have the foundational elements in place: the $65 gamma wall, the wave of US FOMO, and the impending surge in mining stocks. The next 24 hours are anticipated to be highly dynamic, with periods of both sharp increases and significant declines. However, it is crucial to maintain a broader perspective and not become fixated on minor fluctuations. Whether silver concludes the day at $63 and $64 or $66 is a detail relevant to short-term traders, but for long-term investors, it is merely noise. The underlying drivers of this market movement, the Samsung battery development, the influx from China, and the depleted stockpiles, are not ephemeral trading phenomena, but rather fundamental forces that do not simply vanish at the market's close. In Part 4, the concluding segment of this market analysis, I will broaden the scope to provide an end-of-year target informed by this new momentum and equip you with the essential psychological fortitude to navigate the volatility of the coming week. The bear trap has sprung shut and the rocket has successfully launched. Now, we simply need to hold on. We have reached the conclusion of this market alert. We have meticulously examined the bear trap that proved ineffective on Friday, revealed the pivotal moment in London when financial institutions shifted from being sellers to buyers, and analyzed the fluctuating gamma wall at $65. Now, however, I intend to adopt a wider perspective. It is easy to become engrossed in the minute-by-minute price charts and to obsess over whether silver has gained 2 or 3% on any given day. But the most significant indicator is not the percentage gain itself. It is the underlying structure. The market has just communicated a profound message that $61.50 represents the floor. Consider this. Mere years ago, $30 was considered a ceiling. Now, $61.50 is considered an attractive price that billionaires are eagerly acquiring. The entire valuation framework for silver has undergone a fundamental transformation. As we approach the end of the year 2025, we are entering a specific seasonal period that historically benefits the bulls, a phenomenon known as window dressing. In this final section, I will explain why hedge funds, who have disdained silver for the past decade, are poised to become your most valuable allies. I will elucidate the concept of the pain trade theory and provide you with the ultimate strategy for navigating the remainder of December. The bear trap has not merely closed, it has permanently sealed off the possibility of persistently low prices. We are currently in the latter half of December, a critical period for Wall Street as it marks the end of the fiscal year. Hedge funds and mutual funds are obligated to submit their annual reports to their clientele detailing their held assets. Consider the mindset of a fund manager. If silver emerges as the top performing asset of the year, experiencing substantial gains driven by technological advancements and supply shortages, and the fund manager holds no silver, they will appear incompetent. Their clients will question why they did not invest in the best performing asset, potentially leading to the manager's dismissal. Therefore, during the final 2 weeks of December, they engage in window dressing. They acquire leading assets, regardless of price, simply to showcase them on their balance sheets as of December 31st. Their objective is to be able to state, "Observe, we possess silver. We participated in the rally." This action generates an artificially powerful upward momentum heading into the year's end. Funds that neglected silver at $30, $40, and $50 are now compelled to purchase it at $63 simply to maintain appearances. Price is no longer a primary consideration. Securing the position is paramount. This institutionalized FOMO is the catalyst that propels prices parabolically in late December. We witnessed this phenomenon with technology stocks in the past, and it is now occurring with commodities. The news regarding Samsung's battery provides them with a convenient rationale, while the price action creates a sense of urgency. Consequently, if you observe silver appreciating on low volume during the holiday season, do not be surprised. It represents sophisticated investors attempting to appear prescient after being notably absent from the market for the entire year. Meanwhile, you who acquired silver at $25 and $30 are now selling your purportedly overvalued holdings to these desperate funds. Alternatively, and perhaps more advantageously, you are choosing not to sell at all. Markets are inherently unforgiving mechanisms designed to redistribute wealth from the masses to a select few. They typically move in the direction that inflicts the most pain. At this moment, ask yourself, which outcome would cause the greatest distress to the largest number of people? Scenario A. Silver plummets back to $50. Who does this harm? The silver enthusiasts. However, silver enthusiasts are accustomed to hardship. They have endured decades of market suppression and do not liquidate their holdings during downturns. Instead, they increase their purchases. Therefore, a sharp decline would not generate significant selling pressure. It would merely tighten the available supply further. Scenario B. Silver surges to $75. Who does this harm? Firstly, the financial institutions that are heavily short hundreds of millions of ounces. Secondly, industries that rely on silver for solar power and batteries. Thirdly, the general public who are holding cash while inflation erodes their savings. Fourthly, the professional investors and hedge funds that are underweight in commodities. Scenario B would inflict maximum pain upon the established order. It would destabilize bank balance sheets, force industries into a state of urgency, and humiliate professional investors. Consequently, according to the principles of market sadism, Scenario B represents the most probable outcome. The market aims to penalize short sellers and compel hesitant capital to pursue escalating prices. Friday's bear trap represented the final attempt to deter you from boarding the train before its departure. If you remained invested, you aligned yourself with the pain trade. You became the agent of pain rather than its recipient. Let us conclude by considering the broader economic perspective. What is the significance of this $16 price movement? It confirms a transfer of wealth. For the past 40 years, wealth has migrated from tangible assets to financial instruments, from manufacturing to derivative products, from gold to government bonds, and from silver to technology stocks. This trend has now reversed. The Samsung battery is not merely a consumer electronic device. It is evidence that the physical world is regaining its intrinsic value. You cannot manufacture a battery out of thin air. You cannot produce a solar panel without tangible resources. These items require extraction and production. When the price of silver escalates while the bond market experiences instability, it signifies the market's endorsement of tangible reality. It is the market asserting that an ounce of silver, which necessitates labor, energy, and geological resources for its extraction, holds infinitely more value than a digital entry on a central bank's ledger. You are witnessing a historically significant inflection point. Your grandchildren will inquire about your actions during the resource crisis of the 2020s. Did you hold paper assets or tangible metals? Friday served as a test of your conviction in that belief. If you held firm, you have passed. Monday represents your reward, the day the bear trap failed, the day London panicked, and the day the path to $65 opened. I wish to impart one final caution. Just because we are currently experiencing success does not signify the conclusion of the conflict. The volatility is expected to intensify. $2 price swings will evolve into $5 swings, and $5 swings will transform into $10 swings. You must fortify your resolve. Individuals who are excessively leveraged risk being wiped out. Those who monitor the price ticker incessantly will experience undue stress. The strategy remains straightforward. Accumulate physical silver and unhedged mining stocks. Remain steadfast. The market is performing the necessary work on our behalf. The supply deficit is working for us. Samsung and China are contributing to this dynamic. Allow the sophisticated investors to chase the price increases. We are already positioned advantageously. Congratulations to those with diamond hands. Enjoy the rally.